Hey guys, welcome back to Toto Capital. My name's Liam, and in this video I'm going to share with you how we can combine multiple confluences involving a run on liquidity in confluence with our fair value gaps for an entry schematic. Okay, so I've been trading the markets live for about 6 years now. Okay, and in this video I'm going to share with you, a very sort of dumbed down approach on how we can view the markets. Okay, because I think there's a lot of people out there that really try to overcomplicate, try to sugarcoat, try to fluff up, a lot of these smart money concepts. And don't get me wrong, these concepts aren't straightforward, but my job and what I'm trying to do is to make them as simple as possible, to get my points across to you guys in a very simplistic way. Okay, because it's very easy to overcomplicate these things, and in reality there's no real need to do that, and I don't see the need to do that. So my job, as I said, is to really make you guys understand and walk you through why, in exactly what we are looking for. Okay, but I'm going to break it down in a simplistic approach. Okay, so let's just jump straight in. This is NQ, so this is the Nasdaq. Okay, and this is during the London session. Okay, you can see this here. This is the London time-based session where we're looking at executing within the live markets. Okay, so this box here, this is the area that we're looking to execute. Okay, so if and only if prices between or within this time horizon, which is the London session in terms of a GMT perspective, that's 8 a.m. GMT up until 10 a.m. If you're looking at it from a New York perspective, that is actually 3 a.m. up until 5 a.m. Okay, so for you guys that can actually trade the London session, these setups work the same across all sessions. Okay, it's all time based and it's all liquidity based. So whether you're trading the London session, the New York session, it really doesn't matter. Okay, these concepts apply to both. So what you can see here is we're during the London session. What we have is we have sell stops that are simply resting below this swing low here. Okay, this is a significant swing low. So what we understand is we see a deviation, price comes down, deviates below, triggering these sell stops. Okay, so from a retail perspective, they're going to see this as a breakout. Okay, they're going to see they've got sell stops below the low. They're going to sell this on the breakout. They're going to be triggered in short as price pushes below. Okay, so retail perspective is see this as a breakout. Okay, our perspective, we see this as a run on liquidity. We see this as running the sell stops, activating the sell stops. Okay, so now that we've seen this run on liquidity, what we're looking for is, so that's confluence one. Okay, the run on liquidity. We need to see a clear time-based run on liquidity resting below either a swing high or a swing low. In this example, this is our most recent higher time frame swing level. Okay, this is actually on the 3-minute time frame, which sounds quite crazy, but this lines up with a 15-minute fractal low, which is a significant swing point in the market. Okay, it's a significant area of liquidity. So we've identified the run on liquidity. Then what we see here is we see a reclaim in the form of creating a fair value gap. Okay, let me just break that down on exactly what I mean. So, price pushes to the upside, and between these areas here, we created a fair value gap. Okay, so from this candle open here up to the candle high here, we have an inefficiency between these candles. Okay, so there's a clear fair value gap here, which was created from this impulsive move to the upside. Okay, so now that we've seen that, that indicates to us as traders that the bearish momentum is depleted and buyers have actually stepped into this market showing an imbalance in price, i.e. price has moved impulsively to the upside, actually sort of too fast, okay? It's created this imbalance in price, okay? So in terms of an entry schematic, once we see the imbalance, we want to see price come back, rebalance the orders, and then we have clear invalidation below the deviation, and then we can look to target the next area, which is buy stop liquidity in the form of swing points or in the form of equal highs, which you can see here. Okay, we've got a sort of double or triple top area. This is a significant area where buy stops will be resting. And then we also have this significant swing high here. Okay, so in terms of targets, so your entry is out of this fair value gap. Your invalidation goes below the swing low. Give it a little bit of room to breathe. Targets first is this buy stop liquidity at around a 1 to 2, and then further targets is going to be equals highs at around a 1 to 2.1. Okay, so most of your positions coming off up at the highs, and it's up to yourself on how you look to trail the remaining positions. Okay, but let's just break this down. Okay, so what we have is we have a run on liquidity running the sell stops during a high time-based session, the London session. Okay, therefore there's a lot of volatility, there's a lot of algorithmic trading taking place. We're on the 3-minute time frame, okay, and this is where the algorithms are taking place. On the 1 minute, the 2 minute, and the 3-minute time frame is really where these session-based algorithms are executing. Okay, we've seen a push to the upside, creating a fair value gap, and we've seen price pull back into that area after creating it. So we've seen a rebalance after the deviation and after the impulse. Okay, so we've rebalanced the order book right here. We've got invalidation below the low, and we've got clear targets mapped out, buy side liquidity and equal highs. Okay, this is really how you use algorithmic trading concepts or smart money concepts to base a trading plan off of. Okay, it's really this simple. I mean, this may be like a sort of turning point or a sort of it may even be confusing. I've tried to make these concepts as simple to understand for everyone, but it still may be confusing. And if it is, just make sure to take notes and take your time and really watch through the multiple episodes, because these patterns, these entry schematics repeat themselves all of the time. So once you can build this framework on exactly what you want to see, it's as simple as when these confluences line up, you can just execute. You understand you have an edge within this framework. Okay, of course you're going to have losing trades. Of course you can see this is not a perfect setup, right? We wick this fair value gap, we get some heat or displacement to the downside. However, ultimately we have the directional bias correct, and ultimately based on our liquidity concepts, we framed a very, very high probability setup. But don't get me wrong, these setups you will have losers, okay? But ultimately with 1 to 2s, 1 to 3s, you can really start to build an edge within the market, okay? So that's it for this one, and this is how you use time-based liquidity and confluence with our entry schematic using fair value gaps, okay? And using points of liquidity for our exits within the market.